Hello, everyone. Vincent Briatore here. Today, I have with me Mr. Sean Ryan from Node40, who is a expert on tax liabilities and taxes with cryptocurrency. So I thought it'd be interesting to have him on, since now there was the recent letters sent out from Coinbase. I think you mentioned that. What happened with that?
So the letters didn't come from Coinbase. The letters, of course, came from the
Yeah, the
IRS. But
IRS. That's right. Yeah.
yep, there's some speculation that they got their names and numbers of the taxpayers from Coinbase. I don't necessarily agree with that entirely. The IRS has been enforcing exchange compliance for a while now, so likely the taxpayer IDs that they got a hold of were from a combination of information reporting. So that would include Coinbase, but that would also include a number of other exchanges. And well, we really don't know. I'm sure they have other techniques of getting them. The IRS letters were pretty scary. One in particular is quite scary. There's three versions of the letters. I don't know how familiar you are with them, but so there's three versions of the letters.
I haven't got a letter yet, so.
That's very good that you didn't get a letter, because I would be concerned if I did get a letter. So speaking of the three versions, there's going to be about 10,000 letters sent from now, or actually from last month through the end of this month. So not everybody's received them yet. So just because you haven't gotten one yet doesn't mean you're off the hook yet, unfortunately.
Absolutely.
So one version is the let's see, I have it right here. The letter 6174. There's also a 6174A, and then the third one is 6173. So the 6174 versions, they're very, very similar. They read almost identically. They're just simply saying, it looks like we think you have had digital currency. One says, we think you don't know how to report it properly, and the other one says, we think you improperly reported it. And you do not need to respond to these letters. According to the letter itself, it actually says you don't need to respond. But know that if you got one of these letters, the IRS is aware that you're dabbling in cryptocurrency in some form or fashion. It doesn't mean you're doing anything wrong. This is the important part. You want to make sure that this doesn't mean the IRS thinks you're in a heap of trouble. However, the third version, the 6173 version, that's the scary version. That's the one saying that the IRS believes you have digital currency and you have not reported anything. And so the way they know that you haven't reported anything, right? There's no IRS cryptocurrency form. What they're looking at is the form 8949. 8949 is sale of disposition of assets, capital assets. So it's what you would fill out when you sold digital currency or transferred it for another digital currency. So if you bought Bitcoin for Ethereum, that's a taxable event. And so what this means is the IRS thinks you're hiding something, or they have no record of you reporting it, because on the 8949 is a description field, and that's where you would say sold Bitcoin or transferred to something to indicate that you dealt with digital currency. That's how they know if you did or did not report digital currency. Back in 2000, I want to say not 13, 2000, yeah, I think around 2013, they found that fewer than 800 taxpayers in the U.S. had any description on their 8949 related to that. So back to the scary letter, right? The 6173. That is saying you have three options. One, actually, I have it right here, so forgive me for having to go to the actual letter.
Oh no, you're fine.
So we have, looks like if you didn't file a return, they're saying, okay, go file the return. The second thing you can do is, if you did file a return and you did it wrong, correct it and file an amended return. You're still on the hook for penalties and any interest accrued. There's no getting away from that.
How many years back can you file an amended return? Meaning, this kind of situation. Say you've been trading for a few years, you get one of these letters, you're thinking, how far back can I go and try to correct things or refile?
Yeah, my understanding is that you go back until when you started dealing with digital currency, file an amended return all the way back.
I thought there was like a thing, maybe 3 years, or maybe it was 7 or something. You can't go more than 3 years back.
They tell you to keep 7 years worth of tax records. I don't know the answer to the question, whether you have to do 2, 3, or 4. I think there might be circumstances here where the IRS is saying you're trying to get away with something. We're going to go back even farther.
Absolutely. I always heard that you're better off postponing filing a tax return rather than being misleading or falsifying a tax return. Is that do you have any experience with that? Do you think that's correct or?
Yeah, that wouldn't be my advice. My advice would be to file on the best advice you're given, and that's either from the IRS directly, and you have the 2014 memo to go from, where they call it property. And once they've classified it as property, there is very well established property laws and property tax rules. So you can go to that and understand how to deal with digital currency. But you make a very good point. There's a lot of confusing information out there. It's not clear. Even the IRS contradicts itself every once in a while. By reading these letters, I found two very glaring differences between the 2014 memo and now. So one is the exchange of a taxable event. There was some confusion prior to 2018's tax reform bill, which took effect on January 1st. Before 2018, there was no clear answer to the question, is it taxable when I buy Bitcoin with Ethereum or Ethereum with Bitcoin? And I'm just using those two. It could be any digital currencies. And so you have lawyers out there and accountants in very well-respected positions. These are not just people trying to get away with something. They have very strong opinions that, yes, I can defend that this is not a taxable event. I can delay paying taxes until I finally cash out for US dollars. And then you have the others saying, no, this is absolutely 100% a taxable event. Well, now with these letters, in the letter itself, every single one of the letters gives the example that when you're exchanging digital currency for one for another, so including another virtual currency such as an exchanging Bitcoin for Ether, they're saying in these letters that that is in fact a taxable event. To my knowledge, that's the first time they've come out and actually said that. So this changes the game, at least prior to 2018. There's been no talk in these letters or any commentary from the IRS whether that still applied. Whether that applied prior to 2018. We kind of feel confident it does apply now, and most lawyers and accountants are on the same page with that. And the other glaring differences I see in these letters is that they're telling you how to assign fair market value to receipt of digital currency. Now, when you go on, say, Coinbase, and you just buy Bitcoin, there's a dollar, like you're paying dollars and you're getting Bitcoin. There's no question as to what the fair market value of that transaction was. It's whatever you paid. But when you're mining digital currency and you're receiving it periodically throughout the day, throughout the week, throughout the month, etc., you have to pay tax on that as income at the time you receive it. And I understand there's some people out there saying, I don't want to pay it when I receive it, I want to pay it when I sell it. Fine, that's not really the way the IRS sees it. They say you have to pay when you receive it. But the question is, how do I assign fair market value? And fair market value, according to the IRS memo, says that it can be on the date it was received in a manner that is reasonable and consistently applied. But the IRS letters that just came out saying not just date, but also date and time received. So that is a major difference. Now you have digital currency software out there that is saying, what was the transaction value for something that took place on, I don't know, April 1st, 2016? Well, it could be the daily average, or maybe it's the daily high, or maybe it's a daily low. So there are ways. So long as you're consistent, according to the 2014 memo, which is the only thing we've had to go on until just like a few weeks ago, date was fine. So the 24-hour average was fine. Now they're saying date and time. And I have some problems personally with whether that makes sense also. But beyond that, I think they're clarifying the rules while they're saying you're breaking the rules. That's just not fair, and it's not really helpful either. Yeah. Right? It just actually throws more confusion into the mix.
Well, definitely the whole issue of, purchasing one cryptocurrency with another. That's a very good point. I didn't even think about that and the complications that may arise from that, specifically from the contradicting information coming from the IRS. Now, for example, if you compare it to gold, what is the situation now if you use gold to purchase silver?
Geez, I don't know. Those are commodities. They're probably classed differently. So it really comes down to how is the asset classed. Digital currency, they're saying, is classed as property. Unfortunately, it has a terrible misnomer here, right? When you say digital currency, people in their minds, they think, oh, it's currency. So I
Mm-hmm.
can treat it like currency. I can file my taxes as if it were currency. As soon as you change that asset classification or clarify the asset classification and you say it's property, you have to look at a completely different set of rules to understand what that means. So it doesn't have the same implication as stocks, bonds, gold,
Mm-hmm.
silver, copper, whatever.
So it's a lot more similar to buying a home, selling
Yeah.
the home, purchasing another home.
Yeah, okay, so it's funny that you say that. Yes, because a home is property, except that there is a distinction in the tax law about real property, which would be, your home. So in the real property, section 1031 of the IRS code talks to when you're selling a house and buying another house, you're essentially exchanging, so you can defer your tax liability. You're not taxed on that
Mm-hmm.
because you're trading from real property to real property. Section 1031 of the IRS code, it was very vague prior to the recent tax law change. They just said property. Now they've clarified it to say real property, which so now digital currency absolutely doesn't apply. And yeah, it just boils down to property, not currency. It's
Absolutely.
a
It seems
terrible name.
seems like they're just making it purposely more complicated and harder for people to make money. Maybe in a way they are encouraging hodling. So you're better off just holding it because the more transactions you make, the more you're complicating your life, the more you're bringing attention to yourself.
Yeah, I see what you're saying. I hear that a lot. I personally don't believe the IRS is. I don't think they have an agenda. I don't think they're trying to make it complicated, and I also don't think they're trying to make it easy. They're just simply saying, listen, it's property. It's taxed as property. You have to
Mm-hmm.
follow these sets of rules over here. The consequence of that is, of course, major complication because traditionally when you're dealing with property, you're not dealing with the number of transactions that we are in the digital currency world. So I have customers with tens of thousands of trades and transactions. So we each one of those trades is taxable. And it goes even farther in the digital currency world because one transaction in digital currency can actually be taxable on many hundreds of different ways. So look at a UTXO based digital currency. Bitcoin is a UTXO based. So what happens is you receive digital currency periodically. Let's say you receive one Bitcoin every day for 7 days, and you have now 7 Bitcoin at the end of that 7 days. But each one of those Bitcoin has its own cost basis because the
Mm-hmm.
Bitcoin price goes up and down. On Monday, the following week, you decide to sell 5 of them. So the question becomes, what's my gain or loss? Which 5 did I sell? Now, some people say, well, I'm just going to use FIFO. Well, okay, the jury's still out on that, first of all. So I don't want to upset people for what I'm about to say because it could change. It's not FIFO. It's not LIFO. It's not HIFO. It's none of those. It's specific identification. It's a different way of identifying property. So if, in fact, digital currency is property, and I sell 5 of those Bitcoin on the following Monday of the 7,
Mm-hmm.
when that transaction hits the blockchain knows exactly which ones I sold. So I could have sold the one I received on Tuesday, Wednesday, Thursday, Friday, Saturday, not the one I got on Monday or on Sunday. And so each one of those has its own tax implication. Now that's one example of one single transaction. I'm selling 5 Bitcoin, one transaction, but it actually has 5 different tax implications because each one of those 5 Bitcoin that I sold has its own taxable calculation involved. And that's what we do. That's what my company does, Node40, is we look at every single piece of digital currency that was moved, not just sold or disposed of, but moved from maybe one wallet to another wallet, from a wallet to an exchange, and then sold for another digital currency. We track all of that, and it's tiny, tiny pieces. So if you have just a handful of trades, you may have a huge audit trail that lists every single one of those UTXOs. Right? UTXO stands for unspent transaction output. It's the Bitcoin that you receive that you haven't spent yet.
Okay.
Yeah, it's complicated.
Absolutely. Well, it sounds. I know you say that you like the IRS doesn't have an agenda, but at the same time, they're not necessarily encouraging the technology by making because like say real estate or any other investment, there's tax advantages that encourage the development of the technology and stuff, and what are your investments or whatever. And this seems like, especially you're in New York City, you said, right?
I'm upstate New York, but New York State, yes.
Okay, see, so
Even
New
worse.
York
New
is
York
a
State's
rough
the worst.
state.
It's the worst. I'm sorry, not in general. It's the worst for digital currency.
It really is. Do you guys still have a lot of ATMs there? Because I watched the documentary about how New York had a bunch of cryptocurrency ATMs, and then there was the whole state legislations coming through, and things were changing and shutting down. So
Yeah, it's the New York State bit license is what you're referring to. The New York State bit license is the government's first stab at trying to implement some kind of consumer protection policy around digital currencies, which was overly onerous for businesses dealing with digital currency. Now, my company was not in fact impacted here because we do not deal with digital currency through our customer. Like we don't take custodianship of any customer funds at all. All we're doing is we're telling a story of what happened. So we don't have to get a bit license, so it didn't impact us. But things that did impact us was, well, now we're very limited to the exchanges that we can use. So some exchanges, they do not do business with customers in New York State because New York State requires them to get a bit license in order to serve New York State citizens. And that is very problematic because not all exchanges support all digital currency. I mean, I might have some altcoins that aren't even traded on New York State exchanges. So how do I get them off? I live in New York State. The only way for me to get them off right now is to move to another state, live there for 6 months, literally change residency. My car, I don't need to sell my house, but I buy another house or rent, and become a permanent resident of that state. That's horrible.
yeah.
I think that will change in time, but yes, you're right. New York State is a tough state to do business in for digital currency.
Absolutely. Well, the United States is a tough state when it comes to taxes. I grew up in Italy, and most countries in Europe, well, actually, I think all of them in Europe don't tax, foreign income. The United States is one of the few countries that no matter where you make money or where you live, if you hold a U.S. passport, they want their cut. So it doesn't surprise me that they're, doing all this with the exchanges and everything, like Binance shutting down and, requiring all this extra information. And like you said, I had heard that it was Coinbase, but it's funny that all these rumors kind of spread so that, it was Coinbase that gave the information when really, Bittrex is
you're
a big
right.
exchange.
Coinbase, played a role. I think they get a bad rap because of this, because they were kind of like the first exchange that the IRS went after, but they're not the only one. So to hate on Coinbase saying they gave my information away, you'd be surprised. I'm sure your other exchanges also gave the information away.
Oh, absolutely. It's not something they can really refuse, when in a period of time when they're trying to, work with the government as closely as possible so that they can grow the technology. Last thing you want to do is be an obstructionist, so to speak.
Yeah, there's probably one more big piece of information I can share with you about these letters. Speaking of Coinbase, this kind of started right when the IRS issued a John Doe summons to Coinbase and said, give me all your data, and Coinbase was like, no, make me. And they did a good job fighting it, and they ended up not having to pass over all the information. They only had to hand over information for customers that qualified for a certain threshold. And that threshold was customers who had more than 200 transactions and the total was greater than $20,000. Now that's not a random number, random.
And so that part is not a rumor. The $20,000. Okay.
No, that's not a rumor at all.
Well, then I should be getting a letter. I would doubt 200 transactions, but definitely over 20,000.
You have to qualify for both, and it would have to be on a single source. So, like Coinbase or Gemini or Bittrex or Binance, or name your exchange, you would have had to have taken 200 transactions on that exchange, and the big part here is and, not or, but and $20,000. And
this is in a single year. In a single tax year.
In a single tax year, yeah. And then what gets issued is a 1099-K. So that was the agreed upon the form that the IRS says, we need information reporting. And what they wanted to do was the 1099-B reporting, which is, in my opinion, a good indicator of what your actual trade history was. So a 1099-B contains things like your open date, your close date, which was when I bought it, when I sold it, what was the value when I bought it, what was the value when I sold it, and then math gives you your gains and losses. And time held is going to give you whether it's long or short-term gains. So that 1099-B is useful in the sense that it paints a much more clear picture of your activity. But the IRS said, we'll accept the 1099-K, and that's really where things got really confusing, because customers were getting taxpayers were getting 1099-Ks saying that they received a bunch of money, but it's very misleading. That's not really the case. What happened maybe is a 1099-K could report that you received $500,000 in dollars, but really what you did is you were trading and trading and trading and moving currency around, and really it was a $100,000 loss. So you're not obligated to pay what the 1099-K says. You're obligated to pay what you actually owe. So the question becomes, how do I know what I actually owe? And by issuing these 1099-Ks, it gets very, very confusing. And I'm on record, all over the place saying that I don't think 1099-Ks are the way to go. I think 1099-Bs are the way to go. And obviously that would upset a lot of exchanges, because 1099-Ks, they have a huge threshold, right? Hardly anyone qualifies for that, comparatively around the whole ecosystem. Mm-hmm. But 1099-Bs, boy, there's a lot of forms. As an individual, if you had 10,000 trades, and remember this is UTXO based, times all your UTXOs, you could have lots of these forms coming to you, tens of thousands. Now usually it's consolidated into one piece of paper, but they're technically forms being filed. And that can be very, very costly for the exchanges. So I recognize that the exchanges do not want to do 1099-B filings. Also, it's not even helpful in the long run, right? Even if a 1099-B is more accurate within the confines of a single exchange, it's not accurate at all within the context of you as a taxpayer. So it really doesn't add much help overall. But anyway, my long story short, the reason I bring up the 1099-K is because if the IRS says that the 1099-K is acceptable, then why do these letters very clearly tell people how to pay their taxes and what forms to file? Look, Schedule D, they're saying use a Schedule D. Well, if you look at the Schedule D, you know what to put on a Schedule D because you have to fill out an 8949, Form 8949, in order to get the numbers that would go translated onto the Schedule D. Well, the 8949 data comes from a 1099-B, not a 1099-K. So if the IRS is saying use a Schedule D to report your gains and losses, which means you have to fill out an 8949, which means you have to have 1099-B data, where are they getting this 1099-K information from? So I think we need to scrap this. Right? 1099-Ks don't work. 1099-Bs also don't work. Okay, they don't work. And what I would like to see is a better way of reporting this information to the IRS and to taxpayers, because as it stands now, the information that comes in, you might as well just throw it in the trash, and then because it's not gonna be right.
Mm-hmm. So do you feel like the classification as cryptocurrency as property is a correct one, or would you do things differently?
Yeah, so after I blab on about how terrible all this is, yes, I actually do think digital currency being classified as property is fine. There's nothing wrong with that. So just because something is hard to calculate doesn't alleviate your obligation at all to pay your taxes. I mean, there's a lot of things out there that are complicated. I have several businesses. I don't do my own taxes. I have a professional do that. Mm-hmm. The same applies to digital currency. Don't try to do it yourself. You're going to get it wrong if you have a lot of trades. Just hand it over to a professional. Now, I recognize that I'm a little biased here because I run a company that does this for people, but it's important to get it right? That's what the IRS is saying. The IRS is saying in these letters, you're playing in the digital currency world. We don't think you did it right. And another letter saying, we think you did it wrong. So then arm yourself. That's really what it comes down to. If you can arm yourself with the actual information, then you're fine. Now, there's one thing to actually willfully violate the law. Okay, you're always going to get those people. But if you're trying to abide by the law and you're trying to do things right, you're trying to pay your taxes, you just don't know how, you don't understand what is tax deductible, what's not tax deductible, or what is taxable, what is not taxable. Find organizations out there that have these answers, or can at least apply the current property law to your activity and paint that picture. Because, I mean, as a founder of a digital currency accounting software, I assure you I have my ducks in a row. If the IRS comes knocking on my door because they have bad information, I'm going to hand over a very detailed, very readable explanation to the IRS and say, listen, this is what I did. And you can verify this is what I did because one, you have the information from the exchanges, and two, you have a blockchain. Anyone can read the blockchain. So if I'm saying I moved Bitcoin from here to there, if that's on the blockchain, there's irrefutable proof that that's exactly what took place. You can't argue with that. So there's not a lot of loopholes here. So using software to really identify these trades is critical, because most people don't go on one exchange, buy digital currency, and hold it on that exchange forever. Some people do, and that's really super scary. I have very close friends of mine that do, and I just want to strangle them because I'm telling them that that's not safe.
No,
but the typical use case is that you go buy digital currency on an exchange and you bring it down to a hardware wallet or a software wallet. Maybe later on, then you want to cash out, you bring it to another exchange, maybe convert it to a different digital currency, maybe bring it down to US dollars, but you're moving digital currency from one place to another place to another place to another place. Every time you move that digital currency, it's not taxable. That's good. Yours.
Speaking of not keeping money on exchanges, was it last year around Christmas? I think it was last year. Maybe it was Christmas 2017. I don't know if you've been following me, but I got hacked from an Exodus software wallet, and for $67,000. So that was around Christmas. I could have had an Escalade. I'm saving the money, thinking I'm doing the right thing when I could have just bought a car. So what about tax liabilities? And these hacks, they seem kind of popular. So what happens there? I mean, what does the IRS do? Can I just claim and say, hey, listen, I got hacked. The money's not there.
Right. So what happens
as a loss or something?
My stocks or bonds. I think it would be the same applies. So if it's technically a disposition event, right? You've disposed of it, or it's no longer in your possession. So I'm sure the IRS has a code that essentially says this property that I once had, I no longer have, and it didn't get converted to any other pieces of value. It was stolen.
Just like it was just like a loss, right?
Just like a loss. Well, no, I'm sorry. When I say loss, not like a capital loss where you can actually claim it as a loss. Although I don't know the answer to that question. So before I say something I shouldn't say, I'd say talk to your accountant about literal loss of digital currency, because you can burn digital currency too. That's a totally valid way of using digital currency. So you burn it and it's no longer yours. So what's that? Was that taxable? And if so, it could be taxable depending on why you burned it.
Yeah. I mean, because I've seen a lot of people that are, prominent in the industry, if you will, and they've come public with hacks, sometimes millions of dollars. And sometimes these hacks have been questioned if it was, some way to evade taxes. And I just didn't know if it was that simple to, claim such a loss or whatnot on your taxes.
The IRS has more ways of deciding whether you owe taxes than just, asking. I don't have it here, but the IRS form, the letter, the 6174 letter, they're saying that, if you believe you did everything right, then you have to fill out an affidavit. Like, the affidavit is part of the letter. It says, yes, I didn't do anything wrong. And in addition to signing that affidavit, you have to provide them written proof. You have to give them a narrative, like, here's how I use my digital currency, and you're essentially signing your name saying that this is true. And then they tell you, say, we're going to verify this information against bank records, against other data we have, and that's where it becomes scary, right? So if you're trying to avoid taxes, at some point you're going to have a massive deposit into your bank account.
Oh yeah.
And the banks have their own reporting requirements to the IRS. So if you suddenly have millions of dollars flowing into a bank account or a series of bank accounts, doesn't even matter. The IRS is going to be aware of that, and then they're going to say just one question: hey, where'd it come from? So, yeah, you can say that you got your Bitcoin stolen, but if years later you have massive deposits into your bank account, you still have to account for that.
Yeah. Especially now these days, it's becoming harder and harder to turn cryptocurrency into fiat in a untraceable manner. At least here in the United States, Coinbase, Gemini, these kind of places, they all report. So, and Bitcoin ATMs are limited in the amount of cash you can actually get a hold of. So.
Yeah, I mean, I had an uncle who was a financial advisor. He's retired now, and I always complained about paying taxes on my gains, and he would just look at me and just, are you kidding me? You're paying taxes because you made money. You should be happy you're paying taxes, because that means you're making money here.
The problem is that one year you can make a couple $100,000, and then the next year, cryptocurrency, drops 60%, and you have huge losses. And I know that this is comparative, to the stock market and everything, but the fluctuations are just so much, wider and broad that
you want to be careful with your position, right? I mean, how big is your cash position? How big is your digital currency position? How big is your stocks and mutual bonds position? So you want to diversify your portfolio. Put all your eggs in one basket. That's never a good idea.
I wish we could file taxes once every 5 years, and just average it out.
We could never do it. No, it would, yeah, that would be nice. But remember that with the losses, you can draw those losses out now. There used to be a limit. I don't recall what the limit was. Maybe let's say 20 years that you could have this massive loss and you could carry forward $3,000 every year.
Oh, really? That's good.
Now it's indefinite. So you can carry those losses until the day you die. That was a new tax law change in 2018.
That's a really good thing if it applies, obviously, to cryptocurrency.
Yeah, it does. I mean, this is just it's a capital loss, and capital losses they apply to whether that capital was property or not.
Yeah. See, for some reason, I thought it was all within a tax year. So your losses, once you file, you calculate the losses, and that's it for that year. Then the next year, you made money, but then I didn't know you could add it with the previous year and average it out and say, hey, I'm still at a loss.
You can't average it out across multiple years, but what you can do, so if I sold, let's say I have, I don't know, I literally spent $100 on digital currency, and then well, it wouldn't have to be 100, it had to be like $1 million. Like $1 million on digital currency, and then I sold it at a loss for $500,000. I can only offset my tax obligation by $500,000 in any gains that I had. But if I didn't have any gains, I have nothing to offset. So they allow me to take $3,000. That's fine. But now I have this other $497,000 worth of loss. What the IRS is saying you can do is you can carry that forward over to the next year. So the next year you can use that $497,000 to offset your gains. But if you don't have gains in that year, you chip away another $3,000, and you can do that indefinitely until the day you die.
That's good. So if the next year then you make that $493,000 or $96,000, then that's not taxed because you average it out with the year before.
Yeah, I mean, good is relative, right? I mean, you still took a huge loss.
But at least they're helping you out. They're helping you out.
Yes, I agree.
All right. Well, thank you so much for your time. And this is Sean Ryan from Node40. Anything you want to say about your company before we go?
Yeah, I mean, so we help with these letters. So if you got one of these letters, reach out to us. Even if you just want some information, we don't charge for those kind of conversations. So reach us at www.node40.com.
Hey, thank you so much for your time, Brian.
Thank you. Take care.
All right. Thank you.